stocks see a further dip with mid-caps bearing the brunt of selling. Consumer durables, energy and industrials are the big losers, even as FMCG ekes out some gains after the drubbing yesterday.
IndusInd Bank sees a sharp fall on a dip in operating profits and a significant deterioration in asset quality. Analysts cut earnings estimates and price targets for the stock by a sharp margin.
There might be a slowdown in mid-income FMCG segment, but beer, premium liquor and sweets along with hospitality are in fine fettle, reveal the earnings of United Breweries, Radico Khaitan, BKG and Cigarette to Hotels major ITC.
Dixon Tech more than doubles its revenue in a strong second quarter show and ups its guidance for FY25 revenue to 40,000 crore rupees from just above 30,000 crores. But a sharp run-up earlier in the year provides profit-taking in the stock, which is down almost 12%. Good afternoon. You're watching Halftime Report here on CNBC-TV18. I'm Hormis Fatakia. With me is Mangalam Malu on what is a very, very forgettable Friday afternoon. In fact, what has been a very forgettable week for the markets. The Nifty now heading towards levels of 24,100 on the downside, extending its losses down all 5 days this week so far. It's not been good going for the markets whatsoever. And the pain is even more significant in the broader markets.
It is indeed. You know, the mid-cap index falling 10% from the highs, entering correction zone officially as it is defined, is something that, the street does not particularly like. And there's good reason as well. A lot of people were going into this earnings season with decent expectations of at least double-digit sort of earnings growth coming by. So far, the EPS growth on the Nifty has not been more than 5 to 7%. And this is not my words. These are words coming in from Ramdev Agarwal himself. So when you have a higher multiple on higher earnings expectations, a decline would not only lead to, some sort of correction in the stock prices, but also a correction in the multiples and readjustment towards that. And that's something that we are seeing as well. What's even more interesting is that this time on the short side, the FIs have gotten it right. They've, typically there is a tug of war in the very near term from between the FIs and the clients. From the start of the series itself, clients had kept building their long positions, whereas the FIs had kept reducing their long positions. Now they're at around 30-35% long. What's even more interesting, yesterday the Nifty Bank showed some signs of recovery and some signs of life. The FIs took that. They covered some short positions out there. They bought about 2,000 crores in Nifty Bank futures. But today again, smack, they are caught on the wrong side. So that led to a further ferocity of sale that we're seeing on the Nifty Bank itself. So the decline that we're seeing, Nifty is down about 7% from the highs. The Nifty Bank down almost 7% from the 52-week high as well. The Nifty mid-cap index down about 10%. But the broader market's telling you there are nearly 10 stocks which are declining for every one stock which is advancing. So there has been a fair amount of pain in the markets this time around.
Not something to be very happy about, but yes, the market's down almost significantly in the red, and what has been a very, very forgettable week. Fourth straight weekly loss for the Nifty, on course for that. But corporate conversations is what we have to focus on. We'll continue talking about the markets through the show as well. Strides Pharma is the first management that we speak to. The company reported a revenue growth of 20% led by its US business, which saw historic growth of 26% during the quarter. The UK business also outperformed, while the rest of Europe market had a muted quarter this time around. Now, Arun Kumar, who's the executive chairperson of Strides Pharma, is joining in now to discuss the road ahead for the company. Mr. Kumar, good afternoon. Thank you so much for joining in. I'd start off by asking you about what's fueling this growth in the US business, sir. Do you see this momentum sustaining in the second half as well?
Hi, Amos. Yeah, actually, yes. We are very confident that our H2 revenues will be sustainable. We did quite well with our US operations and will continue doing well. So yeah, your question is right that our business could look even better in H2.
If you could give us a sense of how much better it could look, sir. I mean, what kind of revenue are you...
we have guided for the US revenues to be between 280 to 300 million. We are trending more obviously towards the higher end of the revenue range.
But what kind of price erosion are you building in, sir, for this when you give this guidance range?
So we've been speaking consistently that we have a differentiated set of products. We have little over 250 products approved, but we commercialize only 70 odd products. Our pricing discipline is what drives the margin profile of the company. So if we get challenged, we just exit these products. So we've been consistently telling everybody that who's covering us that we have no pricing erosion in our portfolio. That's because we have not introduced the entire portfolio, and we are not building the US business for scale, but for profitability.
All right. Eventually, I remember you telling us, here on the show itself, that you are looking at around 400 million coming in from the US. So what will drive that growth? Will there be biologics, GLP-1 drugs? And also, if you could give us a sense on growth in all the other regulated markets, what's your prognosis for the next half? And more importantly, if you can give us a bit of a crystal gaze into FY26 as well.
Among them, the GLPs that you're referring to now goes into OneSource, the new CDMO business that we've just announced. So that's not part of our US growth story, and that's a CDMO business, obviously, as you know. Our 400 million guideline for the US, in spite of almost $60 million of business going out to OneSource from Strides, will continue to get to the 400 million run rate, 400 million exit run rate in the next 2 years, 2 to 2.5 years, as we have guided earlier, simply focusing on the portfolio that we have and introducing several of our products back into the market at the right time and the right price. So that's our current optimism. As far as the other regulated market, like I had mentioned in my earnings call yesterday, outside of UK, Australia, we did have a muted European business, but we think that'll have a better uptick next year, given that we are partnered. We partner with very major companies in these markets, and until these large players are ready to market in all the larger European markets, they don't launch the product. So our initial estimation of launch dates have slightly changed. So we will see the other reg markets uptake quite significant next year. Having said that, we will have a better H2 even in the ORM markets.
Right. Just a word on OneSource itself. If you could give us a bit of a pro forma on OneSource, what would the margin profile, the revenue profile, and the balance sheet of OneSource look like once you are transferring some of the debt into that company as well? So just basically, for those who are looking at OneSource at some point in time, what would the pro forma of that business look like?
Right. So we actually, we're very close to getting OneSource listed in the next 3 to 4 months. As a carve-out, we've secured a lot of milestones successfully. We're waiting for the NCLT and then eventually the listing. And as you probably are already aware, we've already got an investment commitment of 800 crores at a pre-money valuation of $1.65 billion at OneSource, which goes into a combination of debt reduction and also to CapEx. So pro forma numbers should more look like in the range of about 160 to 180 million dollars, and then EBITDA margins of around 34%. We expect our exit run rate to be about $20 million and EBITDA closer to the 38-40%. And we have a very strong order book with GLP commercialization starting in Q4 and with major patents expiring in FY26. We have a very strong order book to ensure that our exit EBITDA is kind of base going forward. And we're very excited about the business. So the debt to EBITDA will be under 1 in FY26. And we expect to be net cash in the business by FY27.
You expect to be net cash by the end of FY27, if I heard that correctly, Mr. Kumar.
Yes.
So what would be the picture? So you bring down the debt over FY25, 26, and then you become net cash over FY27. Is that correct?
Yeah. So being the CDMO business, the cash generation is very solid. The EBITDA to cash conversion is very high. And the OPEX leverage obviously is a very significant element for that. We expect almost even if I say our exit run rate is 20 million, we expect growth from there. So our free cash generation the next 2 years should be little upwards of $150 million, ensuring that we will be able to not only fund our CapEx from internal accruals, but also being debt-free.
All right, take that point. Thank you so much for joining in and giving us an outlook into what your business looks like from a Strides perspective and a OneSource perspective as well. We wish to converse with you in the next quarter as well, and you probably give us some better guidance on or better outlook or visibility on the way ahead for the other regulated markets as well, apart from the US. Step into a short break, come back. We have the management of Transport Corporation waiting by on the other side. Vineet Agarwal joins in to discuss what was a resilient performance in an otherwise wobbly economic situation. Welcome back. Let's get chatting with the management of Transport Corporation. Again, in an otherwise wobbly market where the mid-cap index is down almost 1,000 points, a little over 1,100 points. This is a stock which is holding with gains of about 4%. Tells you how the performance has been resilient in tough conditions. The company said there's stalling economic conditions due to heavy monsoons, uncertainties of global geopolitical developments and slower private consumption. Despite that, the revenues have grown by about 12.8%, EBITDA has grown by 16%, and the net profit itself has grown by about 22% itself. Well, we do have with us the management of Transport Corp, Vineet Agarwal, joining in. Vineet, thank you so much for joining in, and it's a resilient performance that you've reported. Part one of the question is, how did you manage to do that? And part two of the question is that now that you've done this, with the prospects of the economy looking better in the second half post-monsoons ahead of festive season, do you believe you can grow faster than this 10 to 12% sort of range that you had guided for?
Always good to be back, and not on a day like this, but nevertheless. The growth came, the profit growth came from our CVS business. Our CVS business has done well because of the shift of certain ships that were operating on the coastal waters of India to the international waters. As you know, international freight rates are still quite high, and that has impacted global freight rates and global capacity demand and supply, and ships started moving towards that side. So that gave us a flip in terms of the price realization that we were getting on the domestic market. The fuel prices have also been benign, so that has helped also. And hence our CVS business did relatively well. We did see, however, some weakness on the private consumption side. FMCG businesses have been a little slow. Offtake has been a little weak. But interesting things are happening on the quick commerce side and on the fulfillment. Maybe we'll talk about that later. Your second half of the question.
Now.
Well, okay, sure. So quick commerce is a very interesting development in the last few months. There is the fulfillment aspect is something that we do. We run the warehouses behind the dark stores, and these are across the country. They're not just the domestic, the regular kind of products, the dry products, but we also do cold products. And then we supply them to the dark stores, and then the last mile is done by the dark stores. We don't do that part. So it is a very, very fast growing market. It has, consumer trends are changing very rapidly around this. It's moving away from just impulse buying to even more than that, where people are doing their grocery shopping on a regular basis, as we all are. Yesterday I met someone who said they ordered 2 pieces of banana from a quick commerce company and they got it in 10 minutes. So this is how the trends are, and that is impacting supply chains also and giving great opportunities for companies like us, which are present across the value chain. On your second half of the question, which is growth prospects, we have guided for 10 to 15% on the top line and about 15% odd on the bottom line as well. Usually for us, the Q2 is interesting because that's when all the festival stocking starts happening in advance, and we did see that this time around 5 to 10% increase in festival stocking versus last year. So that augurs well for Q3, Q4 generally for other companies. Q3 is good because MNCs are closing their books. Q4 is good because Indian companies are closing their books. So generally we do expect it to be better also, and also Q4 was a little muted last year because of the impending elections. So yes, I think we should hit our upper end of the guidance that we are giving.
Vineet, good afternoon. Thank you for joining in. An interesting point you made about quick commerce. How big a part of your business has this become as of now? And part two is, since you mentioned Seaways as well, do you expect Seaway margins to also improve in the second half?
Well, it's a very small percentage of our business, quick commerce. It's just one of those areas from in our supply chain solutions business that we are working very diligently on expanding. We do work for other e-commerce players as well, whether it is on the specifically on the big box or on the multi-brand companies or single brand companies as well. We do the fulfillment for them. We also do fulfillment for large FMCG companies, FMCD companies, as well as food companies. But generally speaking, this is not a very large business for us in terms of the overall scheme of things. On the Seaways side, margins will remain stable. I don't expect them to go up further because the global prices have started to soften right now. I think there is also a talk globally for some kind of a recession that might pull back freight rates across the shipping lines as well. So I do not expect shipping prices to, or rather our margins to go up in that sector.
All right, the shipping margins stay around the 30% odd mark itself. Back to quick commerce once again, not because it's a large part of your business, but it's a small part, fast growing part of your business. The nature of that business, is it, full truckload? Is it light, less than truckload? How does that mix impact your performance since you are managing the warehouses? I'm sure you would be doing the to and fro from those warehouses, etc. as well. Is it a margin accretive business? And with more and more business moving away from e-commerce into quick commerce, do you see that shift, changing your margin profile or earnings profile here? Or for logistics, it doesn't matter whether it's Q-com or e-com?
You are absolutely right. I think it does not matter. The latter is more true because it's more from a perspective of what the customer wants. See, the margin profile is more or less fixed in the supply chains today. When at a fulfillment level, also you do now. If you're doing less SKUs, let's say if you're doing 2,000 SKUs versus 50,000 SKUs, clearly the complexity increases or decreases. And that's where you probably end up taking slightly better margins. In quick commerce, actually, the SKUs are quite limited in a city. It goes very, very focused onto each dark store. If it's a area which is where certain types of population live, then those kind of products are available more. So it does not impact that, but it does impact the overall performance of the complexity in terms of how we are delivering. And also the movement is B2B. It is not B2C. It is ultimately going from the warehouse, the fulfillment to a dark store, which is a business as well. So in that sense, it is less complex, I would say, comparatively.
Right. What about, since you mentioned full truckload and less than truckload, Vineet, what's the mix currently among the two, and where do you see that at the end of the year? Do you see that remaining as it is, since I guess less than truckload is around 37% of your freight business? Where do you see that number going?
Not moving too much, actually, unfortunately, because the MSME business is not doing too well across the country. I mean, we know that there is slowdown across and there is some pressure there as well. Credit offtake is not extremely good. And that LTL business has a direct correlation with that. So I would think that we would be having moderate growth there, and we would be at around the same 37% odd kind of number for the full year end.
All right, take that point. Thank you so much, Vineet, for joining in. Not only about your business, but you gave us an insight into other businesses and other consumer trends as well. And like you said, on the one hand, people are ordering just 2 bananas on quick commerce. The other, yesterday itself, Albinder Rinsa went ahead and said, gave an EMI option for all products that are upwards of 2,999 on Blinkit itself, telling you that maybe quick commerce is slowly and steadily replacing e-commerce, because if the purchase decision is made, then why wait and just get it itself? We've seen, an increase in ticket sizes. Thank you so much for joining in. Wish you and your team a very happy Diwali. Let's slip into a short break. On the other side, we have Sanjay Sethi, who's the Managing Director and CEO of Chalet Hotels, joining in to discuss their quarterly performance.
Welcome back. Continuing with our corporate conversation, Chalet Hotels is the next management on the show after a good second quarter results. Hotel additions, renovations and annuity business aided the growth, but the bottom line was impacted by higher tax expenses. We have Sanjay Sethi, who is the Managing Director and CEO of the company, joining us. Mr. Sethi, good afternoon. Thank you so much for joining in. What's been your average room rate this quarter and what are you expecting to end the year with?
Good afternoon and pleasure being back on CNBC-TV18. Look, we've grown in Q2, the rates grew by roughly around 10% for the portfolio, and the RevPAR grew at approximately the same rate, which means that the occupancies were consistent with what we did last year. We don't speak about forward-looking numbers, but the RevPAR growth in double digit is pretty much on the onwell going forward for the hotel industry in general.
Absolutely, the RevPAR growth is visible, and last year wasn't a feeble base as well. We had a fair amount of occupancy by virtue of the G20 summit, not necessarily at your properties, but because of a lot of them being at all other properties. Every other hotel also did see increase in occupancy. So maintaining that itself is a good thing. We've seen that in a lot of the other numbers too. Increasingly, where do you see margins stabilizing for this industry? Because on the one hand, RevPAR is increasing, but on the other, costs are also increasing. 32% margins is what a lot of the hotel companies on a mature basis are making. Do you see further upside from here on as new assets come in, as RevPAR increases, but at the same time costs increase too?
So every hotel is sensitive to its location, and the rates can be very different in each city, and therefore margins do get impacted. Chalet has been consistently delivering 40+% EBITDA margins, and H2 typically is much better than H1, and we expect to deliver robust margins going forward. As an industry, it's very difficult to generalize, but I think the costs, whilst they were growing a little while back, they seem to be under control, and I think Chalet's results reflect that. The demand-supply arbitrage is favorable for the industry. It's going to be favorable for the foreseeable future, which is the next 2 or 3 years. And the inflation seems to be fairly under control. So revenue growth is clearly surpassing cost growth.
Mr. Sethi, you've added some new properties recently, one in Pune, the other one being in Hyderabad. You're adding some more rooms at the Bangalore Marriott as well. When do they break even, and what is the expected additional revenue addition that you're expecting from these properties?
So, Hyderabad's been in place since June of last year. So this is actually the first quarter that we reported like-to-like for Hyderabad. And we've seen that growth come in despite that. The Duke's Retreat, which has been shut down for renovation, expansion, and repositioning, has been out of the system for almost a year now. And therefore, these results that we speak about are despite that shutdown. Bangalore, we will add 130 rooms by end of this calendar year. And therefore, we expect this 130 rooms at a RevPAR maybe of about 7,000-8,000 rupees getting added to the P&L going forward. But these are all incremental rooms in Bangalore, which means our fixed costs are already covered. Therefore, we expect margins to be significantly high with this room addition that we'll do in Bangalore. Duke's Retreat will come into play by end of the financial year with about 146 rooms, but on a monthly basis, we are opening out inventory. So we are currently at only 37 rooms which are operational. By December, we'll be at about 73 rooms, and by January, hopefully around 100-room mark. These new additions, in addition to the pipeline that we're developing, which is the hotel at the airport in Delhi,
right.
The Hyatt Regency in Airoli, Navi Mumbai, and our recently announced acquisition of the land parcel in Varka in Goa is going to be the pipeline for going forward.
One is very excited for the Varka property as and when it comes on stream. I believe it's a couple of years from here on since you've just acquired the property. One final question before we let you go. I remember when we earlier spoke, your annuity business was about 100 crore sort of run rate on an annual basis. Now it's jumped all the way up to 160, 170 odd crores. Where does this number go over the next few years? If you could give us a sense on that. And secondly, because of the fundraise that you've done, your debt has come down significantly to close to around 1,600 odd crores. Where does that stabilize going forward as well? So these two questions.
Sure. So to address the debt part first, we are a high growth company and we are in the capital intensive side of the business here. So we will see some increase in growth. We expect debt to sort of stabilize around the 1,850, 1,900 number with the announced projects that we have in place. In terms of your sorry, I forget your first question. Could we come back to that again?
The first question was on the annuity business, the run rate.
Yes, so that's something which we have 2.4 million square foot of office space that's ready now for leasing out. Out of that, around 65% is leased out now, leased plus LOIs in place. So there will be incremental and exponential growth for the next few quarters on the annuity side of the business till we stabilize the office occupancies in the 90% mark and above. We do expect a serious sort of flow through from the office assets because they tend to throw up high EBITDA margins, and we expect EBITDA margins to be the range of about 84-85% in the office segment of the business. In addition to that, we've got the one residential project in our play. That's trading extremely well, better than we expected. Last quarter, we sold 32 apartments, north of 21,000 price point.
All right, Mr. Sethi, thank you so much for sparing time. Wish you good luck for the rest of the financial year as well, the management of Chalet Hotels. A small programming note as we slip into a short break. As we prepare to ring in the festivities this Diwali, tune in to CNBC TV18 at 3 p.m. on the 29th of this month to hear out some of the biggest market voices giving their tips on how you can make your portfolio prosper this Diwali.
Welcome back. The market continues its slide. Good time to get you all the updates coming in from the F&O end of things as well. There's been a sharp fall in the indices. If you look at it from the 52-week high itself, the Nifty is down about 8%. Nifty Bank down closer to 8% as well. Major indices down anywhere between 8 to 10%. The mid-cap index having gone into correction territory today with a 10% decline from the highs too. If you look at the action of the futures as well, if you look at the Nifty Bank futures plate, that tells you that there is a fair amount of shorting activity which has taken place in the Nifty Bank after the kind of long build-up that we saw. That's been unwound and now shorting has taken place. For the Nifty Bank, the level to watch out for will be the 200-day moving average, which is 49,391. As important levels on the Nifty have been broken as well, 200-day moving average is something that we'll keep an eye out on. But bulls would hope that the 200-day moving average doesn't come by, which is about 600 points lower on the Nifty from here itself. There is a fair amount of call writing at the 24,300 level, telling you on the way up there are a lot of spots of resistance. But at the lower level, they're hoping for psychological support at around that 24,000 mark, which is why the 24,000 put writers are fairly active too. IndusInd Bank, that has to be the stock of the day. A lot of short positions being added out there. Any more positions being added, then the stock risks getting into F&O ban. But speaking about getting into F&O ban, a big slide in Dixon Tech, despite decent numbers, will ensure that the stock goes into F&O ban today. And Chambal Fertilizers may see it exit F&O ban. So those are a bunch of stocks that we'll keep an eye out on. Take a short break, come back, get you more on the markets and stock-specific action on the other side.
Welcome back, and as Mangalam just mentioned, 24,000 is the important level to watch out for now on the Nifty as the market continues to extend losses from the levels. The mid-cap index is now seeing a slight bit of recovery from the lows of the day, but there are some stocks that are still holding out in a market as weak as this one, and one of them is Laurus Labs. And after the second quarter performance, which was another disappointment that came in from Laurus Labs, which was a miss on street expectations, the stock is up 6.5%, with most most of the analysts also reiterating a cautious stance on the stock, saying that the valuations still remain expensive at these levels. But bucking the trend in the weak market is Laurus Labs. Also pull up Home First Finance. That at one point of time was the top gainer on the Nifty 500. That was up almost 7%, and that has seen a very sharp reversal from the highs of the day. Slipped into the red now, is down 1%, is Home First Finance. And lastly, also pull up Dixon Technologies, and that stock, after it was higher in pre-open, the management raised guidance, but the stock seeing some profit booking, 9% lower, is Dixon Technologies. We'll take a short break. Up next on our commodities segment, Manisha Gupta joins in with Sandeep Bajoria, the CEO of the Sunwin Group. Stay tuned.
Welcome back, and joining us on the show now is Mr. Sandeep Bajoria. He's CEO at Sunwin Group. Mr. Bajoria, hi, thank you so much for joining us. I'll come straight to the point, and this is about the edible oil prices continuing to rise in the global markets, and that clearly is impacting the Indian markets because we import 60% of our annual consumption. How are you looking at the prices to begin with? Because when you look at the landed costs, and in the last 1 year, we've seen palm oil prices gain up by 32%, sunflower is up 26%, soybean showing 18% of a jump up as well. And much of these gains clearly have come in the matter of last 1 month.
Manisha ji, first of all, very happy Diwali to you and all the viewers. And as you rightly said, India is importing 16.5 million tons of vegetable oil every year. Our production is only 10 million tons. So our import is 60% of our needs. And our total consumption is 26 million tons, which is about 18 kgs per person per year. And in the veg oil, recently what we have seen in last month is a pretty strong run-up in the international markets, mainly driven by, number one, in Indonesia, because of the production. Every year in Indonesia, production rises about 3 to 4%. And that is approximately 2 to 2.5 million tons. But instead of that rise, 2024 Indonesia has seen production is declining by 5%. So instead of gaining 2.5 million, it is declining by 2.5 million. So total net loss is 5 million tons of palm oil production in Indonesia. On the top of that, Indonesian government is from 1st January trying to put B40, means 40% biofuel mix in the diesel. So with that also additional 1.5 million tons of palm oil will go into biodiesel, totaling to 13.5 million tons out of 51 million tons they produce. So the countries in wherever the higher production is there, these countries are opting for very high consumption in biofuels. So veg oils is not only a food item, it has become a fuel item, green fuel item for them. Same way we see in Brazil also. Brazil is world's largest producer of soybeans, producing about 155-160 million tons of soybeans. And they export 95 million tons to China. And remaining they process, and out of that, whatever 9 million tons of soy oil they get, out of that 9 million tons, 6.5 million tons they use for biofuels, and about 1.8 million tons they consume, and only about 1 million tons they export. So US, Argentina, Brazil, the largest producer of soybeans, using great amount of oil into biofuels. Indonesia, the world's largest producer of palm, using that.
Oh, yes.
And third oil, which is sunflower oil. Sunflower oil this year, because of the moisture stress in Russia and Ukraine, the production is lower by 2 million tons in sunflower oil. So world over, the production is lower. People are realizing, and consumption in biofuel is increasing. There's a reason we run up in prices of 20 to 25%.
Mr. Bajoria, also the kind of hike that we've seen, not just in India with the incense of import duty by 20%, but with Malaysia hiking their export duty by almost to 9.75%. This is the first export duty hike in last 3 years as well. Will that also start showing its reaction in prices?
Yes, Manisha ji. The duty was earlier 8%, so it is now gone up to 9.5, so 1.5% duty. And that, see what's happening now in world market when there's a shortage of supply. So if India increases import duty, the supply side doesn't absorb any shocks. That total burden goes to Indian consumer. And on origin, the export increase in export duty, automatically the buying party, the buyers like India and China has to suffer. They have to get the higher prices. So now it's demand and supply is such right now, and biofuel usage is so high I can give you, Manisha ji, the figure that in world 4 major oil like soya, sun, palm, and rapeseed, the production of this 4 major oil is about 202 million tons. And out of 202 million tons, I can tell you about 42 million tons is going into making of biofuels. That is 21% of world veg oil is going. So we are in for higher prices, but we must understand that historically veg oil prices have been very low, very low worldwide, very low in India, and recent run up because of import duty and recent run up because of overseas price increase, it was bound to happen. And supply shocks are there, and we need to absorb them, and we need to increase the production in India. We need to reduce the import dependency from 60% to at least 50%. And I think Government of India has lined up a lot of programs for it. The oilseed mission has been launched, and their palm mission has been launched. 11,000 crore for palm mission and about 10,000 crore for increasing oilseed mission. They have earmarked for next 5-6 years. I believe the local, whatever incremental consumption of 1 million ton every year, which is required in India, that will be by increasing local production. So at least to that extent, we will be able to manage. But we
something to look forward to in that sense, for sure. Yes.
All right. Look forward to. Thanks a lot, Mr. Bajoria, for joining in. Wish you, your team, a very happy Diwali from all of us. Manisha, thank you for taking us through with that conversation. No respite for the market, still at the low point of trade. Take a short break, come back on the other side. We have Business Lunch taking all the market action ahead.